Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, let's start with the big picture this week. Markets still feel relatively stable, but your note suggests something more complicated is happening underneath. What's really going on?
Yes, that's exactly right. On the surface, things still look fairly stable, but underneath, the story is becoming much more uncomfortable. What we're seeing now is not a recession signal. It's something more awkward than that. Growth is holding up. The US labor market is still firm. Business activity is still expanding, but at the same time, inflation risk is creeping back in, and it's being driven by energy. That combination is difficult because it puts central banks in a bind. You don't have weak enough growth to justify rate cuts, but you do have enough inflation pressure, particularly from oil, to stop them easing policy. So the market narrative of rate cuts are coming is still there, but the reality is pushing back against it.
And oil really seems to be at the center of all of this now?
It is, and I think this is the key shift this week. Oil is no longer just a geopolitical headline, it's becoming an economic variable again. Brent moving above $100 is not just noise. It's starting to feed directly into inflation expectations, into margins, into policy decisions. But more importantly, the real story isn't even crude itself. It's what's happening underneath. Diesel, jet fuel, refined products. That's what moves goods, powers industry, and keeps supply chains functioning. And we're already seeing disruption there. Refinery cuts, supply constraints, rising freight costs. These are the kinds of second-order effects that take time to show up in the data, but when they do, they hit margins and real economic activity quite quickly. So markets have been focused on the oil price. But the real story is the transmission of that shock into the real economy, and that's only just beginning.
And how are equities reacting to that shift?
We're starting to see a much more selective market, and I think that's one of the most important developments this week. The headline indices don't look dramatic. The S&P was down modestly, the Nasdaq a bit more. But underneath that, there's a clear divergence emerging. Companies that are directly exposed to AI infrastructure, semiconductors, hardware, capex beneficiaries, are still doing very well. Demand there remains strong, but other parts of the market, particularly software and more traditional growth names, are starting to feel pressure. And that's partly about valuations, but it's also about a deeper shift. AI is not just creating opportunities, it's also creating disruption. So, tech is no longer one trade. The market is starting to differentiate between the winners of this cycle and those that may be displaced by it. And that distinction is only going to get sharper.
That's interesting, because at the same time, the macro data hasn't really rolled over yet, has it?
Exactly. And that's what makes this environment so unusual. If you look at the data, manufacturing is actually improving. PMIs are ticking higher, particularly in the US. But when you dig into it, a lot of that strength looks like inventory building, companies getting ahead of potential supply disruptions. At the same time, services, which are more closely tied to real demand, are starting to soften, particularly in Europe. So you have this unusual combination: manufacturing holding up, services weakening, and price pressures rising again. That's not a normal early cycle recovery dynamic. It's something quite different, more like a system adjusting to supply insecurity and higher energy costs.
And regionally, are we seeing differences in how this is playing out?
Yes, quite clearly. The US is still in the strongest position. For them, this is primarily an inflation issue. Growth is holding up well enough. Europe has a more difficult problem. Growth is already weaker, and now you're layering energy-driven inflation on top of that. That's a classic stagflation risk, and the ECB has fewer tools to deal with it. And then in emerging markets, it becomes even more acute, particularly for energy importers. Countries like India are already seeing pressure on their currencies and external balances. That's where this shock really bites. So while the headlines talk about oil and inflation, the real stress is showing up in FX, in emerging market currencies. And that's often where you see the more honest signal.
What about credit markets? Are they showing any signs of stress yet?
Not in a dramatic way, But the direction of travel is worth paying attention to. We're not seeing a funding crisis. Credit is still functioning, but the cushion is starting to erode. Yields are moving higher at the front end, curves are flattening, and spreads haven't really adjusted yet to what could be a tougher environment. Slower revenue growth, higher input costs, and limited policy support. And the early signs of stress are showing up at the sector level. Airlines dealing with fuel costs, industrials dealing with supply chains, parts of tech dealing with valuation pressure. So it's not a broad credit event, but it is a gradual tightening of conditions, and that tends to build over time.
So, when you put it all together, what is the real takeaway for investors this week?
I think the key takeaway is this: the market is still holding together, but it's being held together by a very specific set of forces. AI driven investment is strong. That's supporting manufacturing, capex, and parts of the equity market. But at the same time, the rest of the economy is increasingly exposed to what is effectively an energy tax. And that creates a very uneven environment. So the right framework right now is not really growth versus defensives. It's something more specific: pricing power versus margin vulnerability. Companies that can pass through costs, secure their inputs, and benefit from structural demand, they're in a very different position from those that rely on cheap energy, smooth logistics, and falling rates. And the challenge for investors is that this doesn't map neatly onto sectors or regions. It requires much more selectivity.
So, what is the one line conclusion this week?
The market isn't breaking, but it is getting more selective, more fragile, and a lot more dependent on getting a few key things exactly right.
That's it for this week. Stay tuned for more insights next time.